And the key thing that I want us all to learn is, in terms of answering this thing, there's no right and wrong. If you had to argue and you write to me and say, you know what, this is the financial theory, and in your opinion, because this is going to be an opinion, because it's not possible. There's not a concrete answer to this question. Am I right? It's just not, every single one is going to have a different answer. And I think in all of these discussions going forward and assignments, I want you guys to realize that there's at least 30% mark allocation for thought leadership, in terms of you're bringing something new, you have thought about it, and whether I agree or disagree is actually irrelevant. That's not how I'm going to be marking. It's going to be, you've thought about it, you've applied the financial theory, you've linked to the articles, and you've said, you know what, based on these and these reasons, look at my example. They are clearly not following a stakeholder-centric way, and because there seems to be a more, a greater shareholder focus. And that's how you should be answering this question. So there's absolutely no right, and that's why there's also a response to this assignment, in terms of, I hear what you're saying. I just want to highlight this financial theory, maybe consider it in your answer, or et cetera, et cetera. So does that bring a little bit more of a broader understanding in terms of how to answer this assignment? But what is also necessary is your own ideas. So that's making it practical to, an example that you've seen. You've linked to the articles and the financial theory that I've answered. You've written it in a financially professional manner, and concluded. So that's really how to tackle this thing. Any other questions regarding the assignment?
Yeah, I would like to just wonder, I would like to question something. So I work for a German family-owned company. So we're not listed in the stock exchange.
Yeah.
So we're international. So it's quite interesting seeing it from their eyes and sort of watching it from their perspectives. Now, it's owned by a family concern. They're mega wealthy. And therefore, shared value is quite hard for them. I mean, they don't have to, they don't have to share the value. They can make up their working environment. They can do things. So this assignment speaks into a whole bunch of companies that are corporate listed in the stock exchange, but there's also a whole bunch of companies who are corporate but actually family owned or aren't listed in the stock exchange. Can we answer from that perspective?
Absolutely. That is exactly an example of where it is new. It is relating to the articles, i.e., you're going to say, look at this example. It definitely doesn't speak to that financial theory or that guy's opinion, because even those articles are somebody's opinion. And that's why it's not working for whatever reason. And they don't have to. So in this case, it's going to be a complete shareholder focused for these and these and these reasons. So whether it works for them, whether it's sustainable, hopefully, So yeah, I think it's a great example, and I think that's a good example to show that you've taken the stuff that we're talking about and making it relevant to your scenario, and that's exactly what the questions asked you to do, not necessarily a listed example.
Okay, thank you.
Okay.
So
this. Yeah.
Oh, sorry, I'm going to write on what Russell said again.
No worries.
So also where I am with my company, we work with philanthropy. Well, it's a new section that we brought in with our asset management. And they also went over to Grahamstown and its school projects from start to end. So we can use those as examples in our answer why we look at shared value or stakeholder values.
Absolutely, because every single thing a company does, sponsoring a charity event, not sponsoring a charity event, serving tea and coffee, whatever, every single thing a company does has been decided on, and is and as a consequence of the priorities of the organization in terms of where top level management has decided to take this take the company. So it is any example. The only thing I ask you is to say, let's take the tea, for example. It's a very simplistic example, but why does a company have tea? I'm not saying it's to take care of staff, obviously take care of staff, but how does that link in with financial theory? In terms of you need to link it somewhere to the numbers, i.e. it is an actual expense for the company. Why would that company be serving tea? Why would he be caring for staff? It's costs. So that's where I'm saying that suddenly it's not just concern about staff, it's actually spending money. So I'm asking you guys to start talking financially in terms of it's an expense or it's a revenue item. So obviously when a company is taking care of its staff, it's a cost, but it's a thought about cost. In terms of it's a decision by management to take care of company staff. Why not? Why does it want to do this? So that it avoids needing to incur whatever costs of hiring new staff. It doesn't want to lose that particular staff members or whatever the case. So and as a result, leads to customer satisfaction because there's not so each one will be individual. You can't say Nedbank takes care of staff for a different reason why another company takes care of its staff. You need to link it to the practical solver. Why does because maybe it's a, you can't just blankly say Nedbank, why would they be taking care of cleaning staff, secretaries, front end staff? What staff are you talking about and why? You see, so everything needs to be financially backed up in terms of how it's going to increase or decrease shareholder wealth. That's then the one concept that we're dealing with versus where does it fit in with the stakeholder concept in terms of, society at large is moving to more flexible timing. So in order for companies to survive, it needs to offer more balanced working hours, etc., etc. So yeah, that just creates the kind of the tone.
Nicole, could you talk into things like how companies produce, for example, typically pharmaceutical company will produce a product, they'll patent it, it's patented for a couple of years, the patent runs dry, and in the time that the patent is out there, they're milking it, and that's what they're doing. They really are creaming it. I don't think it's ethical, because I do believe that I'm sure that they've paid or redeemed their costs long time ago. So the ROI is sorted pretty years in advance. But some companies these days pass on the savings to customers. Would that be an example of shared value? So for example, if you had to produce something and you found a better way of producing something, and that better way of producing something ended up resulting in a part or a component or whatever it is costing less, a widget costing less. And as opposed to extending on a premium price for the widget because the market is prepared to pay for it, you go in not to go and hurt the market, not to go and break down the market, but you're going to actually go and provide a cheaper widget because you can afford to provide a cheaper widget and still retain decent margins, yet you aren't asking premium because the market's asking for premium.
It's another example, and that one is a tricky one because I'm yet to understand why any company doesn't want maximum profit, if it can. So there has to be a financially rational reason why they are not doing that. Is it because they want to be perceived as being, I'm leaning towards the market disruptor argument, but I'd love that example, and I'd love to hear what you say about it in terms of your opinion, how it sees itself. Yeah, maybe there's just a nice guy that owns this thing and he's saying, you know what, a 10% return is great. The back to the pharmaceutical company is, why do they earn so much? Because they are like this might be my last patent. So a pharmaceutical company, it's difficult to say it's going to, because a patent is only a 15 or 10-year thing. So yes, you need to make maximum profit at that point and milk it, because there might not be something thereafter. So that's just.
But we know it's not true.
and look, again, there's no right or wrong. It's conversation, it's debating, it's back to economic supply and demand. You could link it to say, like, look, a company like a pharmaceutical is going to milk it as far as the demand holds, whereas another person might not. That's a very good concept in terms of you just bring the price. What would that do? Naturally, that would increase demand. I mean, so there's lots to say about it. It's an interesting example. So all of these things are very interesting and definitely worth writing about. But again, link it back to the theory of the articles and the shareholder wealth one in particular. Okay. Is that cool on the assignment? And I look forward to reading them. So what I'm going to do now is I'm just going to go over some of the self-assessment questions that had some problems. Particularly, I'm going to show how we're going to tackle these things in Excel. So I'm going to start off with the easy. I'm going to share my screen.
Sorry, Nicole, can I quickly stop you?
Of course.
Sorry, just a quick last question.
Yes, of course.
So I think taking into consideration what you've said and what we spoke about and what we've read so far, I mean, a person can write pages on this. It's actually a very interesting concept. So you need to tell us how many pages can we write, or what's the limit on writing this piece?
I think there's a word guidance. There's word guidance. That's a good question, Janine. There is word guidance. Again, nothing in finance is hard and fast. So I want to move away from what I asked you to do. Obviously, it is a guidance, and the wording has got, because don't go and do a master's degree on it. So 2 areas of thought. Yeah. The first is obviously an assignment. It's always good to go the extra mile, okay? But writing a 10-pager is not necessarily going the extra mile. The second thing that I'd like to say is that it's quite interesting. When I used to be an analyst, whatever, I used to write many 100-page documents. You get to see somebody you get to phone somebody like some portfolio manager that really doesn't want to speak to you because it's like the 10th analyst that's phoning. So you have literally 2 minutes to say, how's it? You're not going to say how's it, but my point is you're going to say, hi, 3 points. My name is Nicole, 3 points, 3 sentences. And that is your total investment thesis of 100 pages. So my question is to urge you to write and think, because obviously your thoughts is going to be big, but condense it in terms of writing your key themes in the word allocation, so that it doesn't end up like I've now, and they are serving tea and coffee and, there's saying it's employee benefits, or it is, So I think stick to the general guidelines, but make it punchy and thought-provoking.
Okay, thanks.
Okay. All right.
Sorry.
Okay.
Janine, what I found works is I normally make a mind map just of all the loose ideas I have, and then I write a Word doc. For this one, I saw it's 250 words, and generally the response is less. But then you'll find that when you read the other students' responses, you might then actually find another theme that you then didn't write about, that you kind of had thoughts about, that you then left out, and then you can kind of respond with your initial thoughts, but to someone else's. So you don't have to try and cram everything into your first initial response, because you will also need to then respond to someone else's response by Sunday. So also remember that you kind of need to keep some comments for that as well.
Cool. That's a good idea. Thanks. Thank you.
That's a good thought. Okay, guys. So you guys, please, I'm going to be guided by what you are, what you guys are communicating to me in terms of where you're at in terms of the time value of money questions. So I'm going to race through the time value of money ones, which are generally the easier ones, and then spend a little bit more time on the DCF questions that's got the more complicated comments. Okay, so just question number one is, here's a motor dealer offered some securities for sale to the public on March 2008. Under the terms of the deal, the corporation promised to repay the owner of one of these securities $100,000 on March 2038. But investors would receive nothing until then. So there's no payments in between. This is a straightforward present value, future value thing. Investors paid the motor corporation $24,099 for each of these securities, so they gave up $24,000 on March. So why I want to just go through this is because you guys can see that that is, from the investor's perspective, an outflow. So it's a negative 24. And question one is based on the 24,000 price. What rate was the corporation paying to borrow the money? So, of course, as an investor, we would give out 24,000. You can have it either or. So you can see it from the investor's point of view. You can see it from the corporate's point of view. What's important is that your present value and your future values are two opposite signs. Otherwise, you would have gotten this wrong. So I said it's an outflow to me. I get back 100,000 in the future. What is my number of periods? It's the 2038 minus the 2008. Okay, so 2038 minus, so it's N equals 30, and I solve for my interest rate. How do I do that in Excel? I write equals rate, and I literally link the first, it tells me my period, and I link it to the 30 number of periods. Payment, I've got to tell Excel that there's 0 payments in between, okay? That's different to the financial calculator. You always have to write 0. And then my present value is linked to the negative 24,000, and my future value, I've told it, it's 100,000, and then I click enter, and that is solving for the interest rate. Then it changes the question a little bit. It says, okay, now assume that in 2029, the securities price is 42,000. If an investor had purchased it for the 24,000, what would it have earned over the investment period? So that is now from 2008 to 2019. So all I've done in the calculation, I've just changed my number of periods from 2019 to 2008. My present value originally started being the same, 24,000. My future value is now the 42,000 that I was told, and I solved for the interest. I would have earned that. Okay. And then point C, if an investor had purchased the security on the market in 2019. So now that changes my present value. So it's saying, forget about the 24,000. I'm an investor that now comes in 2019 after the securities has been running for a while, and I buy this for 42,000. What annual rate of return would I have earned? So I bought it at 42,000. I'm going to get 100,000 back. My investment horizon now changes to 19 years, which is the 2038 minus the 2019. And I would have gotten a 4.62 return on that. Any questions on this one?
Nope.
Okay, thank you. Question 2. Suppose you are committed to owning a $190,000 Ferrari. You believe your mutual fund can achieve a 12% annual rate of return, and you want to buy the car in 9 years on the day you turn 30. How much must you invest today? So it's asking me how much I need today. That leads you to know that this is to answer the present value, or to solve for the present value. I'm given the future value in this case. I can get a 12% return on it. The investment horizon is 9, and therefore I solve for the present value. Again, in Excel, you write PV. Okay, that's because that's what you're trying to solve for, and I link it to the interest rate. Here it tells you the rate, what you need to fill in. The number of periods is 9. Again, I've got to write that there's no other payments in between. There's no annuity embedded in this transaction. And I've told it what the future value is in this case. And then I solve for present value. Pretty standard. The reason why that's pretty standard is because there's no compounding periods, which we're going to get to. So this is question 3. You are scheduled to receive $15,000 in 2 years. When you receive it, you will invest it for 6 more years at 7.1% per year. How much will you have in 8 years? So this question is the first time that it starts questioning our timeline skills in terms of we need to understand exactly where our present value lies and what our number of periods is. So here it's saying we are going to receive this in 15 years, in 2 years. We're going to receive the 15,000 in 2 years' time. So even though we're going to receive it in 2 years' time, it is still our present value of our calculation, okay? Because that is the first point in time. Then it's going to say how much, or it's asking how much we're going to get in the next 6 more years. So that's why my N is 6 and not 8. And it's told me that I've got a 7.1% return, and how much do I have then at the end of the 8 years? Okay, guys? So future value is equal to future value, open bracket. We've given our rate. Periods is linked to the 6 years. Again, I've told it 0 payments. There's no annuity. And it solves for our present value. Our future value. Okay. So now let us go on to any questions on these easier kind of calculations.
Just one question. Do you always assume that it's going to be compound interest when they just specify, as opposed to, what's the other one, simple interest? Do you always assume that it's compound interest for such questions?
Always.
Okay.
The financial work, it always, most of the time. I think a financial contract will have to write to you in bold that it is simple, because most of the financials just happen on compound. But
okay.
It will have to specify. So assume it's a good question, assume it is compound. Okay, so here we've got a more tricky type of question that basically integrates nominal, effective, compounds, and timelines. So Bilbo Baggins want to save money to meet 3 objectives. Okay, so as soon as you see in the quiz this weekend, there might be also these integrated questions. Just just give me 1 second. Sorry, I've just got a question. Oh, okay. I think that's, sorry. All right. Okay. Okay, so as soon as the information might ask you, again, there's 3 or multiple things going on in one question, you need to split it out and deal with the transaction individually. So here we've got 3 transactions going on. First, he would like to be able to retire in 30 years from now with a retirement income of $24,000 per month for 25 years. So that's an annuity. Every month he wants to earn 5 years. So already you can start saying, what's the question? How much do you need to save? Okay. With the first payment received 30 years and 1 month from now. Why is that important? It's because it's telling you that the annuity is going to be paid at the end of the first compounding period, or not compounding, first annuity period. So it's an ordinary annuity and not an annuity due. Okay, so always when you're given equal payments for over a period of time, that then becomes an annuity, and make sure that it is an ordinary annuity or an annuity due. Please read up on that if you haven't already. It's quite important because you need to change the number of periods in your calculation. If this question was different in terms of it said that your first payment would be received on the first day of retirement, you guys remember with an annuity due, there's an extra compounding period that you need to account for. Okay. Second, you would like to purchase a cabin in Rivendell in 10 years' time at an estimated cost of $340,000. Third, After he passes on at the end of the 25 years of withdrawals, he would like to leave an inheritance of $1.5 million to his nephew. He can afford to save $2,500 per month for the next 10 years. If he can earn an effective annual return, that's what that EAR stands for, he can earn 10% before he retires and 7% after he retires. Effective annual return. Now, I always need to say, as soon as you see effective, okay, now remember this, when you are compounding, you need to use the nominal rate, not the effective. So that's why step one in this calculation, when you see an effective return, your immediate response is, without even digging deeper, change your effective rates into the nominal rates. So I'm going to do that for both of them. So before retirement, my effective rate is 10, and my nominal rate is calculated automatically by Excel. If I'm solving for nominal, I want equals nominal. I link it to the effective rate, and then I tell it how many compounding periods are going to be in my, or what the number of compounding periods is, okay? So in this case, sorry, it's 12, not 4. I just wanted to say to you as an example, if I changed this to say compound quarterly, I would write 4 in there, and it immediately changes my calculation. Okay, so first step, you always change to nominal rate. And that's exactly what I've done to the after retirement section. So again, it's linked to nominal rate. The second step is obviously I need to work back, because I need to have a certain lump sum on retirement, and then I also need to have an annuity while he is on retirement. So I know that my future value is going to be the 1.5 million. I also have payments. In the previous example, we didn't have monthly payments in between. So notice my signs. So I have said I need 1.5 million at the end, and that is also the same direction as the 24,000. You can do it either way. You can use the retirement as a positive, but then again, that needs to be the exact same direction as your monthly payment, because those are going to be then cash inflows to you. So whatever direction you prefer, just make sure that your cash flows are correct in terms of they're the same direction. So I need to solve for my present value at retirement stage. Okay, so that is 25 years of retirement. So I equal, open brackets, my present value on retirement needs to be included my rate. Okay, now what am I going to use my rate? So the first thing is there is more than one compounding period in my year. Okay, I'm compounding more than once per year, better said. Okay, so what am I going to do? My rate is linked to my nominal rate, but it's a monthly interest calculation. Am I going to be earning 6 or whatever I've linked it to that is now after retirement? So that's the 6.78. Am I going to be earning 6.78% monthly? No, I'm not. That is my annual nominal rate. So when you are doing a calculation, it needs to be the annual rate divided by how many times you're compounding, so that your interest rate directly links to your compounding period. So here I've got months. So each month I'm going to earn 0.57% interest. Now see how many months I've got. I've got 25 years, 12 times by 12 months. So I've told the computer nicely that I'm going to be earning 0.57% each month, and there's going to be 300 months. Okay, so that's going to be the same when you've got quarterly. What am I going to do if I had quarterly compounding? I would use my nominal rate and divide it by 4 to tell the computer that that is how much interest I'm going to earn each quarter. How many quarters do I have? Then I would have gone 25 times 4. Okay, so remember that our interest rate, we always divide, and then my number of periods are always times. Yeah?
No, I was going to say I couldn't see the screen, but I can see it now.
Oh, cool. Okay, so as a general rule, step one, sorry, I can't, I've got this, you guys can see, I've got the 3 key thoughts principle. Step one, convert an effective interest rate into a nominal rate. Step 2 is divide your interest, your nominal interest rate by the number of compounding periods. Step 3, times your N or your number of periods by the number of times you're compounding. So the interest per year, I can't say it again, divide number of periods times by the number of compounding or number of times you're compounding. So here we've got 12 months for 25 years. So at the end of retirement, I'm solving for the present value. He needs the 3.7 million. Step 3. Okay, but that's now what he needs at the end of the period. I need to calculate. Now, in between today and the next 30 years, when he retires, there's a 30-year period up to the point that he's going to retire. In between that, at year 10, he wants to buy a car. So now I need to work out what he would have saved in that first 10 years, deduct the amount of the car, and then carry on saving up until the 30 years is finished and he's retiring. So in the first 10 years, I've got present value is 0. He is going to make payments of 2,500 for 10 years. Notice I have got how many compounding periods? 10 years of 12 months. I've got 12 compounding periods in my year. So I've got 120 compounding periods. Look what I've done with the rate. I've divided it by 12, which is my number of compounding periods. And again, obviously, I've just linked it to the interest rate before retirement. Then I've solved for my future value. Notice that that is a future value at the end of 10 years. And again, I've told the computer that there's a payment, an annuity of 2,500 every month for 120 periods. Just to go a little bit off track, if I had to say to you that this becomes an annuity due, sorry, excuse the tongue twister. Notice in my calculation, I have not answered the calculation this type question. Excel assumes this is a ordinary annuity. If you want to say, change it to an annuity due, and the question had to change its wording by saying that Bilbo is going to invest 2,500 and the first payment is going to be today, you know that that is an ordinary annuity due, and you change this to a 1, I think it is. Yeah, to 1. That makes my compounding at the beginning of the compounding period, and you can see that it's gone up by a little bit because I've changed it to an annuity due. Okay, so you can write 1 or 0 if you want. 0 is for ordinary annuity, but the computer knows that, so you don't have to actually tell it. Okay, it just assumes that. So at the end of year 10, he's going to have the 499. I've got to deduct the value of the car at year 10. Make sure that is the value of the car at year 10, because they can spin it around. They can say that the value today is 340,000. Is the value then in 10 years' time 340,000? No, it's different. So make sure that they're talking about the future value at that point. It is 340,000, and his savings after 10 years will then be 159,000. So that becomes the starting point to my last calculation. I know that he needs a total amount. Oh, sorry, I'm working on an ancient computer. He needs a total amount of 3.7 million at the end. He starts off his retirement now with a balance left over after his car purchase of 159. Payments is what they're trying to solve for, because it's asking you how much should he be saving. I've got how many compounding periods? I've got 20 years left of saving, and I times that by 12. Again, the interest rate is divided by the number of compounding periods, and I solve for the payment. Notice in Excel, to solve for the payment or the annuity is equal PMT. And again, it's easy. You just link it to the applicable Excel sheets. So rate is linked to rate, number of periods is the 240 months, and then present value is the 159, and then the future value is the 3.7, which he needs at the end of retirement. Okay, any questions on this one?
So, okay.
This one is about as hard as it's going to get. So if you understand the ins and outs of this question, you'll be very good to go for your quiz. As you can see, the course builds up on each other. So it started off with some easier questions, and then it ended up in a grand finale. Okay, so that's how we're going to be going until week 3, really. Let's do one more question, because I see we've got the other ones are not really as difficult as this one. A financial... Yeah?
Just one question around the guide. Will this be available? Is it going to be available as a Zoom session, or will the document, the spreadsheet, be available for us to go through?
I'll upload it. I'll email it to Shingi now to upload it right now after as a separate mail to you guys. No problem. Yeah.
I also have a question.
Yeah.
In Excel, there are a couple of different formulas for calculating payments. There was PMT, there's PPMT, and there's a whole bunch of them. How do you know which one is the correct one to use?
Payment. That's the correct one. What is
it gets confusing. I looked at a couple of the formulae, and there's PPMT as well, and it looks almost the same.
Let me just get the definition.
Mm.
Okay, I'm not going to read this right now.
But should we just assume for the purposes of this course that we use PMT and FV and so on?
Don't use this one. Let me just return spam. Yeah, I'm not sure the difference. I'm sure there is a difference, but just use the PMT, okay?
Okay.
Yeah, okay. Thank you. Shows you guys are working. A financial planning service offers a college savings program. The plan calls for you to make 6 annual payments of $13,000 each, with the first payment occurring today, your child's 12th birthday. Beginning on your child's 18th birthday, the plan will provide you $30,000 per year for your 4 years. So this question is good to just start introducing that you might have negatives, positives, and the direction of the cash flows might change. So what I've done here is I've just shown you how to nicely draw your timeline. So rather than working with the age, always write 0, because that's as today. And then you can easily see how many years you've got. Okay. So even though this is not a particularly difficult question, it's just nice to always show, so you keep a track, because this becomes a bit more tricky, because when they start playing on the words in terms of, then it's child's birthday, the next birthday, etc., you just plug it in exactly where it lies. This question is just the first one to bring the concept of IRR into the thought. I don't want to spend too much time on the IRR, because we're going to be doing this at length next week, but it basically just solves for the rate when you've got unequal cash flows. So yeah, I'm not going to go into IRR right now, but it basically is where net present value equals 0. But keep that in the back of your mind, that you can use IRR to solve for a rate. But for the purposes of this quiz, you're not going to be doing it this way. You're going to be doing it this way in terms of plugging in your interest per year. I wanted to show you just in Excel, instead of doing if you want to solve your interest, you say equals INT, okay? and then you're going to link it again to your present value, your future value, etc., etc. Okay. All right. And then the last one, I just wanted to show you how to, it's again just plays on the number of periods. So an insurance company is offering a new policy to its customers. Typically, the policy is bought by a parent or grandparent for a child at the next birth. The details of the policy are as follows. The purchaser, the parent, makes the following 6 payments to the insurance company. So again, I've said that this payment happens at the end of the first year. So typically my year 0 will be there, my present value, okay? But I've just listed exactly where my payments happen. They are not the same. They are unequal cash flows. So this just shows you how to solve a question with unequal cash flows. Now, you can either do it like this, where I've actually plugged it in and it literally creates, calculates an NPV. This will be the first, for example, you can go equals NPV. NPV is the same as present value. You link it to a rate, and literally you can link all your cash flows. Okay, that's one. Again, more something for next week. Okay, but in this one, all I did was I had each cash flow. It's fine, and I had a calculation for each of them, and it's easy to just roll it down for the other. For each year in Excel. So here I had to calculate the future value of each one of these cash flows. They are not equal. So that's why I had to repeat the calculation, but each one had the same rate. But the difference is that the periods change. So this one, notice that it happens at the end of the first year. So do I have 6 compounding periods? No, I've only got 5, even though there's 6 payments. For this one, I only have 5. So make sure in your quiz that you are very clear on the number of times that you're actually going to earn interest on that particular cash flow. Because in this question, it could have been quite easy to just assume 6, right, 654. But if you actually draw it out like this, you can see I'm not earning any interest in my first year. Why? Because I'm only depositing the money at the end of my first year. And that is the core concept between an annuity and also an annuity due. Okay. The difference between making a payment today or only at the end. So here you can see my number of periods changes from 5, 4, 3, 2, 1. This cash flow, I'm not going to earn any interest on. So it just remains 950. At the end, I just literally sum all my future values. What have I done? I have basically changed this 750 to be a year 6 cash flow. This 650 made that a year 6 cash flow. So they're all future valued at a given point in time. And then I can make a sum. So then the second step of this calculation is obviously that's what I'm going to be depositing, but my percentages change. Sorry, I didn't read this, the second part. After the child's 6th birthday, normal payments are made. When the child reaches the age of 65, he or she receives $250,000. The relevant interest rate is 10% for the 6 years and then 7% for all the subsequent years. Calculate the future value of the payment at the child's 65th birthday. So here I am solving for the future value because it has told me that that the interest rate is 7% and I've got 65 minus 6 years left in this instrument. So again, another area where you just got to make sure that you're on top of the number of periods. And then I'm solving for the future value of it. So again, equals future value, link it to the rate, link it to the number of periods, and get a future value. Why did this question ask me this? To calculate the future value, because I actually only make $250,000 for the child, while the actual insurance company makes $350,000. So this question just shows the profit of the insurance company's perspective. Okay. All right. Any questions on this one? Okay. So guys, this is basically the full extent of this week's work. If you're comfortable with these questions, obviously spend, build up time value of money. There were a couple of more questions on the easier side in time value of money. That's just to really drill the concept of present value, future value for those that are not yet comfortable. So it really gets just the core basic understandings right. And then you move on to the DCF calculations where you've got your effective and your nominal and your annuities a little bit more integrated. But I think this, I mean, obviously you're going to have some easier questions, some harder questions. It is timed. And yeah, good luck, really. If there's any other questions.
Nicole, I have a question.
Okay.
How can I find it that number of periods? Yeah? I have a problem of number of periods on time bill of money.
Okay. You just always seem to be getting that part wrong. You say? Is that right?
Okay.
No, I'm asking, is that your question? You just want to understand how you calculate number of periods?
Yeah, exactly.
Okay. So the number of periods, the way to think about number of periods is to ask yourself, how many times are you earning interest? So if I say to you, you're depositing money in a bank for 1 year, and there's only once a per annum compounding, okay? How would you logically think about how would you be earning interest on that? You're going to be saying your lump sum times by the interest rate, okay? But only times 1, right?
Okay.
But if I had to say to you that let's just put a simple example on it quickly. Let's just do that. So, okay, this is going to be a very crude question. So let's say I'm having 1,000 Rand and I'm earning 10%. Let's say I've got 1 year, okay? So my number of periods is going to be 1. And number of periods is not actually how many years I have. It's how many times I'm compounding. So that's important. So here, I'm earning interest for 1 year. That means I am earning interest only once, okay? And that equals then 1,000 times by my 10%. Not so. Oops.
Okay.
What am I doing here? Sorry, equals. My system is extremely slow with all the Zooms and everything going on. Okay. So I think if I'd asked you this question to say, you're depositing money, 1,000 Rand into the bank, you're earning 10% for 1 year, I think you would be comfortable with telling me that the interest you would have earned in that first year is 100 Rand. Are you happy with that point?
Yes.
Okay. Now, let's say you are changing the question to say, I still am only investing for 1 year. Okay, so my investment horizon is not changing, but I'm compounding twice in the year. What interest would you have earned? Do you agree? You would have earned 10%, but have a look. Because it's you compounding twice per year, you need to calculate interest on interest. So you would have said, in the first 6 months, I would have earned 1,000 times by, would you be earning 10% in 6 months?
Yeah.
What would you be earning? You would have been earning only 5% interest in that first 6 months.
Yes.
So note that the 10% is an annual rate. Okay, so your first 6 months, you're going to be earning 50 Rand of interest. All right. So it's not the 100 Rand. You're going to only be earning 50 Rand.
Yeah.
Now, what is your closing balance of this after the first 6 months? It's the 50 plus the 1,000 that you have invested.
Yeah.
Now, how much interest are you going to be earning in the second 6 months? You're going to be earning interest on the 1,050 Rand. But again, you're going to be earning 10% interest? No, you're going to be earning interest only for 6 months. So now you're going to be earning 52 Rand 50.
Yeah.
So at the end of the period, your balance would be 1,102. How much interest have you earned? It's the 1,102 minus the amount that you originally, invested, 102 Rand.
Yes.
What is your effective interest rate? Is the 102 divided by the 1,000 that you originally invested. So you made 10.25%. That is equal to your effective rate, because you've effectively earned higher than your original nominal rate. Okay. So now look at my number of periods. I've got the same years. I've got 1 year, but I've compounded twice in that year. Does that answer a bit better? Hello? Yeah. So as a rule of thumb, you always take the number of years times by the number of times you're compounding. So in this question, you're compounding twice. So I said 1 year times by 2. If I had 4 compounding periods, I would have said 1 times 4. So you always times by the number of times you're compounding. And for the interest rate, you always divide by the number of compounding periods. So like the 10%, I divided it by 2. If it's quarterly compounding, I divide by 4. So I recommend try the questions, and if you're still not comfortable, let's make an individual Zoom, and that's on anything regarding the assignments or the questions, guys, and that relates to everybody, is to please go and try. And really, if you guys have tried all means in terms of Googling it and asking a friend, please, I'm always here to help. Pop me an email. I've got fairly good turnaround times. Happy to answer questions. Okay.
Okay. Thank you.
Anything else?
Nicole, how
Yes.
soon are you going to upload these questions?
Right now. Shingi, give me a nod. Is that okay? Can I mail it to you right now? Thank
Awesome.
you. It'll happen right now. Okay, guys, the last thing I just want to say is a comment about next week in terms of your assignments. So next week there's going to be 2 assignments again. There's the quiz and at the end of the week, and then there's also a not a respond type for assignment, but it's basically going to ask you to calculate a net present value, IRR, and payback period. But again, to answer the quiz and that assignment, you need to have worked through your self-assessment questions. So your steps in this course is to always do your Connect chapter, then attempt your self-assessment questions in Connect. Remember that Connect questions, self-assessment is not for marks. It's your own learning, and that's how you prepare by yourself. And then you are graded at the end of the week or during the week in terms of assessments on Moodle. Those are graded, and always watch out for quizzes and always watch out for your assignments that you have to post on Moodle. Okay, guys.
Just the smart book questions for the first 2 chapters. A lot of it related to the American tax system and statutory laws. So in the economic quizzes, it was book quizzes, and you couldn't really avoid those types of questions. But I don't really feel that's so relevant for us. So we won't be asking like that, and we can kind of avoid that.
So the self-assessment questions, and that's a good posting in terms of, because the smart book might, and you can get lost in the smart book, spend too much time on it, because obviously it's broad as a textbook should be. But so that's why the self-assessment questions are there. So I would recommend move as efficiently as possible through your smart book, and then attempt your self-assessment questions in Connect, because those are going to be the direct type of questions that you can expect in your quiz.
So almost use the ebook instead of the smart book, and just kind of highlight, just get through the content, ignore the silly questions, and then rather do the self-assessment questions that you post.
Yeah, because I'd also like to say to you is how much of that content, even whether it's the ebook or the smart book, how much do you absorb in terms of you actually being able to answer this kind of question? It's impossible. So the best learning is to work very quickly, just to understand what you should be looking out for in a question, so that you say, okay, yes, you understand that there's this concept of effective and nominal. So you've read it. This is point number whatever. When you hit it in the self-assessment questions on Connect, then you refer to your textbook in terms of, okay, how do I answer this type of question? All right. So that's why I recommend that you quickly move through your smart book, and that is the quickest because it's highlighted the most important sections to you. That's why the smart book is so nice. But yes, if you're going to start getting lost in like the US tax system, that's where the smart book becomes less efficient. So the smart book is highlighted. Just remember that there's an effective nominal concept. Just remember that there's a perpetuity concept. Just remember, etc., etc. But by no means can you solve a question, you're going to spend years going through the chapter before you get to a point. So it's best learning on the job while you're going through questions. Okay. Definitely. Most efficient.
Nicole, can I help you?
Okay, Shing.
Yeah. Just go through. So the smart book highlights the sections. The sections that are highlighted are the sections that are critical for the students to know.
Exactly.
So what it is go through it's okay to read through the books. Read through the other parts that are not highlighted just to get an understanding if you need be. But focus on the parts that are highlighted because those are the parts that contain the critical information that will affect your self-assessment.
Okay, Nicole.
Yeah.
So if I just make a reference to the first chapter, I mean, it's talking about primary and secondary markets and the firm and the corporation, sole proprietor. That is not really the direct questions that's going to be in the quiz. It's more going to be focused on calculations.
Absolutely.
Great.
Why is that chapter in there? Of course, and that's why the smart book is so nice, because it's great to spend half an hour on that chapter. Now, the person that's never heard of primary and secondary markets, it is an outcome of this course. I can't just skip it. I can't just say, well, listen, guys, there's only the 4 calculations that you really need to know, because you do need to have in the back of your mind the term. So that's why the smart book integration can really work if it is used, smartly. So again, it's there for probably what I would have liked in my university, because in my days there was no smart book. I had to say, okay, well, I'm going to leave this chapter out altogether and focus on only the calculations. That's probably what I would have done as a student. But now it's there for your use to say, okay, in 20 minutes, these are the relevant concepts. Let's move on. You see,
okay, cool. and thank you.
Box as a financial manager in terms of it's there. I promise you, it is there. So that's why I wouldn't just skip things, but I would definitely use the tools.
Read fast.
Read fast, and then go straight into the put an hour limit on a chapter reading as a first, as a maximum, an hour, can't be more. Then you start your questions, and that's where you really learn. Okay, guys?
Fantastic. Thank you, Nicole.
Cool. Good luck for the quiz. Please work hard. Okay. I know it's tough out there, but all the best. And please don't hesitate to email. Okay, guys? Take care. I'll send out the document now. Bye.
Thanks. Bye.
Thank you. Bye-bye.